Before I show you the math, I want to tell you something a little embarrassing. I was 27, making $68,000 a year, which felt like real money. And every single month I would think I should really start investing. And then I'd think, after I pay off this card, after my next raise, after I move apartments, I had a reason for every single year. And then I blinked, and I was 35. This video is what I wish someone had shown me at 22. And if you're anywhere between 25 and 50, it's going to change how you think about money. Stay with me. Here's what we're covering today. First, the exact dollar cost of every year you wait, and I mean exact. We're going to run the numbers live. Second, why the two most powerful retirement accounts in America are basically invisible to most people. Third, the specific 4 moves I made starting at 35 that got me back on track. And fourth, what to do if you're starting even later than I did, because this still works at 40, at 45, even at 50. Let's go. Meet Alex and Jordan. Same age, 22 years old. Same job, same $60,000 salary, same city, same everything. The only difference, Alex starts investing $400 a month at 22. Jordan, and Jordan is me, keeps meaning to start and waits until 35. That's it. That is the only variable. Watch what this single decision does over a lifetime. Alex invests $400 a month into a plain S&P 500 index fund. 10% average annual return. That's the 100-year historical average. Alex never picks stocks, never watches CNBC, never panics, just sets it and forgets it. By age 65, Alex has $2,108,000. $2 million from $400 a month. That number is not a typo. Jordan does the exact same thing. Same $400 a month, same index fund, same 10% return, but starts at 35. By age 65, Jordan has $905,000, almost $1 million, which sounds great until you put it next to Alex's number. The gap between them is $1,203,000, over $1 million, from 13 years of waiting. Jordan invested for 30 years, Alex invested for 43. But those extra 13 years at the beginning were worth more than Jordan's entire 30-year run. Or, let me put that another way. Jordan invested $144,000 more than Alex in total contributions, more money, more years of investing, and still ended up with $1.2 million less. That is the price of waiting. That is compound interest working against you instead of for you. Now I want to stop with the numbers for a second because I think it's easy to hear $1.2 million and have it feel abstract. So let me translate it. At a 4% withdrawal rate, which is the standard safe retirement withdrawal, $1.2 million generates $48,000 a year in passive income. That's $4,000 a month for the rest of your life, without touching the principal. That gap between Alex and Jordan isn't just a number. It's whether you retire at 58 or work until you're 70. It's whether you help your kids with a down payment or can't. It's real life. It was my real life. So why do people wait? Because I've heard every version of this excuse. I lived it. Number 1, I'll start when I make more money. I made $68,000 and thought I needed more. The truth is, $50 a month matters more than you think, and I'll show you that math in a minute. Number 2, I don't understand investing enough yet. This is the sneakiest one because it feels responsible. But you don't need to understand investing. You need to understand one fund. I'll tell you which one. Number 3, the market is too high right now. I'll wait for a crash. This one has literally never been a good reason in the history of the stock market. We will come back to this. Number 4, and this was my real one. I'll do it after I handle this other financial thing first. Debt, move, emergency fund. The list never ended. All right, here's where we turn the corner. You need to know about two accounts. Most Americans either don't have them or don't use them correctly, and they are the single biggest legal tax advantages available to regular people. Account 1, the Roth IRA. You put in after tax money, meaning money you've already paid taxes on. It grows completely tax free, and you pay zero taxes when you take it out in retirement. Zero. The government just lets you keep it all. The contribution limit in 2025 is $7,000 a year. That's $583 a month. Account 2, the 401k, specifically if your employer matches. This is literally free money. If your employer matches 4% and you're not contributing at least 4%, you are leaving part of your salary on the table. Every single pay period. These two accounts together, maxed out, can make starting at 35 almost as powerful as starting at 22. Not quite, but close enough that it doesn't matter. Inside those accounts, you only need to know about one type of investment to start. A total market or S&P 500 index fund. Specifically, if you're at Fidelity, that's FSKAX or FXAIX. At Vanguard, that's VTSAX or VOO. At Schwab, that's SWTSX. These funds own tiny pieces of the 500 largest companies in America. When America's economy grows, which it has every decade for over 100 years, you grow with it. The expense ratio is around 0.03%. That means for every $10,000 you invest, you pay $3 a year in fees. $3, not 1%. Not a financial advisor's 1.5% cut. $3. So here's what I actually did when I finally started at 35. Step 1. I opened a Roth IRA at Fidelity. Took about 11 minutes. I put in $500 the same day just to make it real, to make it not theoretical. Step 2. I went into my HR portal at work and bumped my 401k contribution up to at least get the full employer match. I was leaving 4% of my salary on the table every year, for years. That ends the day you watch this video. Step 3. I set up an automatic transfer into my Roth IRA on the first of every month. I never see the money. It just goes. $500, then $583 when I hit the max. Step 4, and this is the one most people skip. I never looked at the balance during a market downturn. In 2022, my account dropped about 20%. I watched everyone I knew panic sell. I did nothing. The market recovered. It always has. Now, what if you're older than 35? What if you're 40, 45, or 50 right now? Let's run it honestly because I'm not going to sugarcoat it and I'm not going to scare you either. Starting at 40, $400 a month until 65. $530,000. Starting at 45, $298,000. Starting at 50, $158,000. Now, those numbers are with $400 a month. If you're 40 or older, you can contribute $1,000 extra per year to your Roth IRA. That's the IRS catch-up contribution. And your income is probably higher now than it was at 25, which means you can invest more per month. Someone putting $800 a month starting at 45 ends up with $596,000. The story isn't over. It's just different. One more thing before I let you go. I know someone watching this is thinking, but the market is so high right now, I should wait for a crash. I had this thought every single year from 27 to 35. Here's the data. If you had invested in the S&P 500 at its all-time high, every single time it hit an all-time high, you would have still outperformed someone who stayed in cash, waiting for a dip, over every 10-year period in history. The best time to invest is not when the market is low. The best time is when you have the money, which is now.